Good morning. Thank you for joining us for today's webinar on commercial rent and transfer tax changes. I'm Bob Sharon, partner and leader of the firm's tax practice. I'm pleased to introduce you to today's presenters. Tom Corey is a principal at Friedman and director of the firm's state and local tax group. He has more than 30 years of experience. Tom has worked with clients in a broad array of industries and advises high net worth individuals with respect to both their personal and business state and local tax matters. Joining Tom is Alan Goldenberg, a principal at Friedman, and he is a member of our state and local tax and our tax controversy groups. He focuses on tax transactions, including structuring, advisory tax services, and tax controversies. Alan has more than 10 years of experience representing taxpayers before the IRS and local tax authorities. Friedman is a leading provider of accounting, tax, and business consulting needs of public and private companies since 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry and all regions where we operate. Friedman's State and Local Tax Services Group is dedicated to helping clients avoid pitfalls and maximize their tax position in a complex and evolving tax landscape. The goal of today's program is to help you understand the recent changes to the commercial rent tax in New York City and to provide a deep dive into New York State and New York City's real estate transfer taxes. At the conclusion of today's webinar, we will attend to questions from our listeners. You can submit those questions and communicate with us throughout the course of the webinar using the Q&A feature on the lower portion of your screen. We would also be delighted to schedule a time to speak with you on a one-on-one basis to better guide you on your particular situation. Tune in for our next webinar on November 21st, when our SALT professionals will examine Wayfair compliance and the new practices that businesses are adopting now that 43 states have implemented Wayfair economic nexus thresholds. And at this time, I'm pleased to turn the presentation over to my colleague, Tom Corey, who will kick off the program.
Thank you, Bob, and thank everyone for joining us and listening in. We're interested in commercial rent tax. It's one of the larger areas of questions that we're always receiving, and also since the firm does a lot of real estate work, we are always kind of bombarded with what's happening in both New York City and New York State with respect to the transfer taxes. Ironically, in both situations, in fairly recent days, we've had changes in the commercial rent tax law and the real estate transfer tax area. Alan, you want to kick off about the New York City commercial rent tax?
Sure. Thanks for joining us today. Commercial rent tax is a rather unique tax that most other jurisdictions throughout the country don't have. But it's one of those things that it's a cost of doing business, particularly in Manhattan. And that tax is actually imposed on tenants, renters, of commercial properties in Manhattan, south of the middle line of 96th Street. It's a 6% tax that is imposed on the base rents that are paid by a tenant annually. This tax is often overlooked. As I said, it's unique, so we don't see it very often elsewhere, but the city has really made a strong push in recent years for compliance and adding questions on both its corporate as well as partnership tax returns, really requesting taxpayers document the fact that they have, in fact, filed the requisite commercial rent tax returns.
The city knows that, frankly, because I have a friend of mine works for New York City and we went to law school together. So the city is aware that somewhere around, let's say, 50% of the folks that should be complying with the commercial rent tax are not. And they are making a concerted effort to go after those folks and make sure they can bring them into compliance. We often find situations where you have individuals that may have offices in New York City that are being advised by either accountants out on Long Island or in New Jersey, and they are not fully aware of the commercial rent tax implications that their client's presence in New York City has. And as a result, we've gotten situations where we've had to go into voluntary disclosure for companies that may have had commercial rent tax liabilities going back 10, 12 years.
And oftentimes when taxpayers are either issued a notice for noncompliance of commercial rent tax, or they approach us because they have not filed back year returns, the city will assess penalties, interest and penalties on the outstanding tax obligations. So the voluntary disclosure program that Tom mentioned is rather a great way of bringing taxpayers into compliance, because while interest would still be owed on any outstanding tax liability, the city under the program would waive the penalties associated with the late filings and remittance of the tax.
And of course, if you request it, and pretty much everyone does, you can get a limited look back, which is usually 3 previous years in the current year. So if you've got a company that may have liabilities going back 8, 10 years, it's really a very great tool for coming into compliance.
So Tom, let's jump into some of the details here as to who is required to file. We know that it's tenants, but it's not all tenants necessarily. The filing obligation starts for those tenants that have base rents of $200,000 of rent annually, though the tax itself does not kick in until the rents exceed $250,000. The tax itself, just so you understand, it's a 6% tax on the rent obligations, and what is considered rent for tax purposes. It's a very broad definition under the city administrative code. We often see taxpayers get tripped up with this, thinking that all their obligations are really the base rent that they owe just to occupy this space. But that's not true. It extends well beyond just simple rent. It includes utilities. We often see real estate escalations that are included as well, insurance. All these items are aggregated together to determine whether the tenant A exceeds the $200,000 filing obligation, and then B, whether they exceed the $250,000 threshold when the tax itself kicks in.
Right, and we say utilities. We're not talking about utilities that are separately metered. We're talking about when you are paying items to the landlord. Same thing when you have you're paying a percentage of the property taxes, et cetera. Alan, just jumping back for a minute, why don't we define where the commercial rent tax is implemented? What sections of New York City are tenants subject to commercial rent tax?
So the commercial rent tax is limited to the borough of Manhattan, and it includes properties from the center line of 96th Street and south, though there are carve-outs for certain areas in Lower Manhattan and the World Trade Center area. That obviously is to promote growth after the events that happened a decade ago that sort of acted as a tax incentive for businesses to move down there and to avoid the additional commercial rent tax obligations. So the tax itself, Tom, is a 6% tax, but the city allows for a reduction or a deduction of 35% of the base tax. So ultimately, the commercial rent tax is really applied to 65% of the base rent, thereby really an effective tax rate of 3.9%. For tenants with rents between $250,000 and $300,000, there is a sliding scale credit that gets applied that they can take advantage of. And here we have just a very simple example of how this credit works. Here you have a taxpayer with base rent of $280,000. We've applied the 65% base to that times the 6% tax, gives us $10,920 of commercial rent tax. And here's where the credit computation kicks in. You take really it's again the tax, the beginning here, the 3.9% is really the 65% and the 6%. And then they have this ratio here of the 300,000, which is the high water mark in order to be able to claim the credit, less the amount of base rent that the taxpayer paid, divided by 50,000, results in a credit of $4,368. You then subtract that from the commercial rent tax, and you end up with a $6,552 liability on that.
Alan, as we mentioned earlier, there's been some recent changes which really were geared to benefit small businesses in New York City. One of the problems with the commercial rent tax, obviously, is that with the increase in rents, and I don't have to talk about that too much because we see people that have had been in business in the city for many, many years, not being able to keep the business going anymore because the rents were just pricing them out of the market. To try to counter that to a limited effect, obviously, the city has been trying to make the commercial rent tax for these people a little bit less onerous. Alan, you want to outline that a bit?
Yeah, there are really two major changes, falls into two baskets. The first are for tenants who have rents of $500,000 or under $500,000 and total income, and that is a particular term that is defined within the administrative code, of $5 million or less are fully exempt from the commercial rent tax. They receive a credit that really offsets any commercial rent tax liability. So that really carved out a lot of tenants within Manhattan that previously were subject to the tax. But because of their rents, their higher rents and maybe lower total incomes, the city is getting them a nice benefit here to avoid the commercial rent tax. What they also implemented was what they deemed a small business credit, and it applies to tenants who have base rents between $250,000 and $550,000 and total incomes of $10 million, less than $10 million. So for tenants that have greater than $10 million, even if their rents fall within the $250,000 to $550,000 range, they would not be eligible for the small business credit. And what the small business credit does is it applies two factors, a rent factor and an income factor component. And we have a nice example of it here that kind of plays out how this credit works. So here you have a base rent of $510,000 that falls within the bookends that $250,000 and $500,000. Total rents are $9 million under the $10 million threshold. So this taxpayer here would be eligible for the small business credit. We compute the tax the same way that we have before, $19,000 and change. Then we apply this rent factor. You can see the rent factor is 0.8. The income factor is the 10 million less than 9 million divided by 5 million, ends up getting to a factor of 0.2. The small business credit then takes those two factors together and they're multiplied by the commercial rent tax that's computed as regular, and the end result of that is the small business credit. Here you can see the taxpayer received over $3,000 of credit under this new credit.
Alan, yeah, these changes, again, were initiated, hopefully, especially the first one that eliminates it altogether. help, certain mom and pop type bodegas and other things that are out there that really were getting hammered by the commercial rent tax. One thing that we should talk about is the subtenant deduction. Generally, with commercial rent tax, if you are subletting, if you are a tenant and you're subletting some of your premises to a subtenant, then the subtenant's rent is subtracted from your rent in determining your ultimate liability. Now, how this works basically is when you do the calculation, you start out with your base rent, then you take the subtenant's rent, subtract it from your base rent before you apply the 35% haircut, and then you go through the calculation. One of the questions that's come up is we've had businesses where, particularly when you're renting space on either a daily or a weekly basis, can that client take those days as subtenant rent? The city's position on this is the days do not have to be consecutive, but there have to be at least 14 days during the year where the particular company is renting that space to be able to deduct it and treat it as subtenant rent.
Another question we also get within the subtenant realm are companies that maybe are related or they're occupying a similar space. And what the city has really done is crack down on these related entities in terms of subtenants. They really like to see a defined area within the space for the subtenant. Oftentimes they'll ask to verify that employees are only associated with one entity and not the other entity, and to verify the fact that the subtenant rents are reasonable for that space that is being subleased, to ensure the fact that there's no monkey business going on with respect to the commercial rent tax.
One of the questions we often get is we've got situations where you have folks that may be renting several different spaces in different buildings in the city. And the question is, are they aggregated for purposes of determining what the base rent is? And the answer to that generally is no. Each space is considered on its individual. Now, as Alan was saying, if you try within the same building to set something up to try to avoid the tax, that's a different situation. Here I'm talking about multiple legitimate leases on their own. Commercial rent tax is really something that a lot of individuals and businesses have overlooked over the years. Alan and I must get at least, 10 or 20 inquiries a year that with respect to voluntary disclosures for commercial rent tax. And it's something that is really often overlooked by a business, and you really need to focus on that, because there's no guarantee you'll get a voluntary disclosure, although generally the city is pretty charitable in that regard, because they want to get people on their tax rolls. But it can be a very onerous burden to have to go back 8 or 10 years.
Yeah, and as I mentioned before, the fact that New York City has added questions onto their income tax returns, documenting compliance with respect to commercial rent tax, just heightens both the taxpayer as well as the tax preparer and advisor's role in ensuring compliance with respect to the commercial rent tax. So, even if you've received a notice or and you have the city coming after you for commercial rent tax, You may not be eligible for voluntary disclosure, but it's worthwhile reaching out to us because often we may be able to limit the number of years for which the city will go back to collect the commercial rent tax, and maybe we can work out other plans with the city so as not to feel the full burden of the commercial rent tax.
I mean, just, to give a little bit of a war story here, I mean, I had a situation where a restaurant in New York City was being, their accounting work and everything was being done by a New Jersey-based small practitioner who really wasn't aware of the commercial rent tax, didn't follow it that closely. What happened was their initial rent was below the threshold for even filing. And then they subsequently, the business was doing well, they subsequently took on the store next to it, broke the wall down, and in essence doubled their rent. They were not aware of the commercial rent tax and became subject to it, whereas initially they were not. So, this is something you got, as your business grows and develops, you've got to be aware of. Alan, you want to move on to the transfer tax?
Sure. So let's jump into transfer tax, and we've seen a lot of movement within the last couple months with respect to the state transfer tax. Just to get a overview of it, the state has a real estate transfer tax that's applied to conveyances of real property. The rate is $2 for every 500 of consideration that is paid. Though there is a change now as of July 1st, that rate now is increased to 0.65% for New York City residential property, for which has a consideration or a sales price of over $3 million, and for commercial properties over $2 million. The city, New York City, has its own real estate transfer tax. And that has a sliding scale rate depending on the type of property that is sold, be it commercial or residential. Typically, these taxes are applied to the seller of the property, though if the seller is, say, an exempt entity or for some reason doesn't end up paying the tax, the state and or the city can go after the buyer for the transfer taxes. It's also important to mention that there is an additional New York State mansion tax. It only applies to residential properties for whose consideration is $1 million or more.
Alan, if we just stop for a minute and talk about the potential if the purchaser agrees to pay the transfer taxes as part of the deal, the gross up is that the tax is basically added to the consideration, and then you have the calculation for the tax on the grossed up consideration.
And then, so just to get back, so the mansion tax is the third component of the state and city transfer tax. It's only applied by the state on residential properties over $1 million. That rate was 1%. Up until July 1st, and now the New York State has implemented a progressive structure, which we'll get into more, but this is kind of one of the big updates to the changes in transfer taxes. Typically, transfer taxes are done at closing. You'll often see many documents being passed around. One of those documents, and often multiple checks will be written out for these taxes. There must be filed within 15 days of closing. What we see more in our practice, Tom, are transfers of controlling interest. You want to explain what that means?
Sure. What generally used to happen and is that folks didn't want to pay the transfer tax, so they would drop the particular real property into an entity, and then they would transfer the interest in the entity. And it's been repealed now, but for many, many years, there was a real property transfer gains tax in which the tax was at the rate of 10% on the actual gain on that. And the gain was defined in certain ways, but that was, when you combine that with the New York City real property transfer tax rate plus the state, you had folks that were really getting hammered. Real estate industry complained like crazy about the gains tax. It was eventually repealed. However, again, the controlling interest, the city decided and the state decided, hey, we're not going to allow these folks to avoid the transfer taxes by dropping these pieces of real property into entities. They came up with this controlling interest transfer, which basically says that if you transfer 50% or greater of an entity that owns taxable real property, then that transfer is going to be subject to the respective taxes.
Right. So where we often see that are, for our clients, are LLCs own real estate. The LLC itself is sold, because the LLC owned the property, and more than 50%, let's say 100% of the LLC was in fact sold. There would be transfer tax based upon the consideration of the selling price of the entity. Now, there also is an anti-abuse rule that is in place, such that transfers or conveyances, particularly of controlling interests that occur within a 3-year time span, are aggregated for the 50% test. And where we often see that is maybe year 1, 20% of an entity is sold, year 2, another 20% is sold to the same purchaser. And then year 3, if there's going to be another sale of the additional 20%, for transfer tax purposes, these are really aggregated together and deemed one transaction for these, transfer of a controlling interest.
One of the issues here is, well, when is the tax from? In other words, what was the actual transfer date? And you've got that kind of aggregation anti-abuse rule. The transfer date is as of the first transfer. So if folks are trying to avoid the tax by doing it over a 3-year period, or I've seen them even actually go out longer than that, and the city or state go after it if they deem it to be a concerted effort to avoid the tax. But the tax is imposed as of the date of the first transfer in these kind of situations, which of course leads to significant interest.
Another area where the transfer tax applies are to leaseholds. Oftentimes, businesses aren't aware of this, but for very long-term leases, and for state purposes, have to be for more than 49 years, and it includes renewal options, then the transfer tax would apply to leaseholds. There are some requirements that are listed here in order to apply the leaseholds to the transfer tax, but to determine what that consideration is, New York State has given over some rules to compute the present value of the leaseholds for transfer tax purposes. And here we have an example of how this applies. Here we have a 75-year lease, $100,000 of rent per year under the terms of the lease. The applicable rate is the AFR rate. The city requires that current AFR rate to be at 110%. There's a present value computation that is done. Here you can see the present value of the 75-year lease is $918,000 and change. Multiply that by the New York State transfer tax rate, results in a state tax of $3,673. Okay. Let's jump into some exemptions, Tom.
Yeah, I mean, the exemptions, when we have you see mere change of identity, this is a situation where you have, excuse me, where you have, for example, individuals that own real properties, as, for instance, tenants in common, and they decide they want to put that real property into a partnership form or an LLC form. So they drop the partnership, the property into the partnership LLC, and they each own interests equivalent to their TIC interest prior, percentage interest prior to dropping the real property into the entity. In that kind of a situation, the transaction is exempt from real property transfer tax for both city and state purposes because it is considered a mere change of identity. If, however, the percentage interests change between prior to putting it into entity format and after, then it's likely there's going to be some kind of a tax involved. It'll be at the equal to the change in percentage, applied at the change in percentage of the interest. Just as a word of caution, when you are going for a mere change of identity exemption, you need to file the returns themselves and claim the mere change of identity, real property transfer tax exemptions within the form itself. You can't just ignore it and not file, otherwise you're going to be subject to the tax.
Right, and Tom, the same goes, also applies to gifts, which are also exempt from the transfer tax. If you look at the transfer tax returns, there is an exemption section that have multiple boxes on them that you check off depending on which exemption applies. Just to touch briefly on gifts, in general, gifts of real property are exempt from transfer tax, but a word of caution on that, that if there is a relief of indebtedness, we see this often with property that's subject to a mortgage, one would transfer a property, gift it along with the outstanding mortgage to a donee. That donee would actually, the transaction would be subject to transfer tax because there is a relief out of indebtedness by the donor. So it's something to keep in mind. We also see this in marital rights situations, divorce cases, where there's a transfer of real property from one spouse to the ex-spouse for, obligations under the divorce. Those can be deemed consideration for transfer tax purposes as well.
Alan, we've got up here, when do the transfer taxes come into play? The New York City real property transfer tax applies to transfers with consideration in excess of $25,000. Basically, in the residential situation, if the transfer is for consideration of less than $500,000, the rate is 1%. Greater than $500,000, it goes up to 1.425%. Commercial, the rates are less than 500, 1.425, and in most cases with commercial real property, got greater than 500,000, which is in New York City is likely, you're going to have 2.625%.
Yeah, you can see clearly from the rates here, these are much more onerous than the state rates. So oftentimes we're much more concerned with the impact of the city transfer tax versus the state tax.
With respect to leaseholds, whereas we have, basically a formula for New York state purposes as to what type of a leasehold transaction would incur the tax, New York City takes a position that all leasehold transactions are subject to CRT, except if what you're receiving here, the consideration that the landlord is receiving, just falls within the category of rent, the definition of rent that falls within the commercial rent tax. Does not have to be subject to the commercial rent tax. It just has to be classified as rent under the definition of commercial rent tax for purposes of avoiding New York City transfer tax on leaseholds.
Right, so let's move on to some exemptions. and some other concepts here. We touched upon them with respect to the state transfer tax, but the city also has a controlling interest rule, similar to the state, whereby 50% or more of interest in an entity that owns real property is transferred, the city transfer tax would apply to that as well. And the exemptions also, there's a gift exemption for the New York City transfer tax as well.
Right.
One interesting thing that really a ruling that came out from the New York City Tax Appeals Tribunal was just released on October 7th. The matter involved an entity, a partnership in New York City that paid New York City transfer tax. One of the partners of that New York City partnership was a tax-exempt entity, a 501c3 entity. That entity, as a tax-exempt, in theory, would be exempt from the New York City transfer tax, or so it thought. And it tried to claim a refund for its percentage share of the real estate transfer tax that were paid to New York City by the partnership. And the New York City Tax Appeals Tribunal denied that refund claim, stating that the non-for-profit wasn't the entity that paid the tax. It was the underlying partnership that paid the tax. And since the partnership itself was subject to tax, there was no refund obligation by the city to the tax-exempt partner. So interesting thing to keep in mind.
Alan, that seems like a little bit of a push they went to reach that conclusion. They didn't want to allow the refund in that kind of situation, so they took a rather circuitous path to get there.
Okay, so let's just jump into a couple of some of the changes that we briefly mentioned earlier about the state transfer taxes. The rates went up for properties, for residential properties of $3 million or more and commercial properties of $2 million or more, went up from 0.4% to 0.65%. In addition, we mentioned this at the beginning, the mansion tax was expanded only on New York City properties. So that does not apply. It is a state tax, but the expansion of the city of the mansion tax only applies on sales of New York City properties. Throughout the rest of the state, if residential property is sold for $1 million or more, the rate remains at 1%. When it comes to the city, however, there is this graduated rate depending on the home price, which we can see here goes up to 3.9%, and that really is a way for the state to capitalize on some of these, very high value properties that we're reading about in the paper being sold, in Manhattan. Sure,
the state was very much aware that the transfer tax in New York City with respect to residential real property was significantly higher than its rate. And frankly, they're trying to close budget gaps and raise revenue. So I saw some of these prices where you've got apartments, condos being sold for 15, 20, 25 million and beyond. They want to get their piece of the pie.
And one last change that we just want to highlight came out about a month ago, and that is for New York State and New York City transfer tax purposes. There is now a disclosure when an entity is the purchasing organization buying the property. There must be a disclosure of the names and addresses of any shareholders, directors, really any authorized person, or as what the code word here is. So this way the city and the state know who to go after for any outstanding taxes. They want to put it out there. The federal government has had for a number of years a similar policy for certain entity real estate transactions occurring in various cities throughout the country. And now it seems like the state and city are jumping in on that as well.
Now, this was, I think, a result of there were many instances where you had, individuals that were located overseas that were basically buying, they don't want to identify themselves. They were forming entities and having the entity purchase very, very high-end condos located in New York City, and to counteract that anonymity, the state enacted these changes.
Okay, so with that, we open the floor to questions. One question I see here that came in takes us back to the commercial rent tax, and that is, how often am I obligated to file a commercial rent tax return? The commercial rent tax is not based on a calendar year. Rather, you look at rents from June 1st through May 31st of the following year, and annual returns for those taxpayers that have above $200,000 in rent, but less than $250,000 of rent, and therefore do not have a tax obligation, or those taxpayers that, because of subtenants, for example, receive a full credit on their commercial rent tax, they just have to file an annual return, which is due June 20th. For tenants that do have a commercial rent tax liability, quarterly returns are due, and those quarters are June, July, August, September, October, November, etc., with the returns being due 20 days thereafter.
Alan, I see, excuse me, another question coming in. It says, does the $200,000 annual amount, in other words, with respect to commercial rent tax, just obligate a renter to file a non-taxable tax return? The answer to that is yes. At $200,000, you are obligated to file a commercial rent tax return, but you are not assuming, let's say you have a rent of $210,000. You would not be subject to the commercial rent tax. The city wants to know, for instance, they're aware of how they defined rents for commercial rent tax purposes. And frankly, as Alan mentioned earlier in the presentation, many times people do not calculate their rent properly. So they want to know if you're near the threshold, if they have to take a look at it or not. And they'll look at the return and they can make an evaluation.
Another question here that's popping up is, do the real estate transfer taxes apply to 1031 exchanges? It's a good question. And the answer to that is maybe. The real estate transfer taxes apply to the consideration that's given in the transfer. So the question is whether there is consideration in the 1031, is there boot, what's part of that exchange? Interestingly, New York State and New York City, a couple of years ago, both issued rulings with respect to reverse like-kind exchanges. And those are situations where the replacement property is first acquired by the qualified intermediary, and only later the original property the transfer property is identified. In both those, in both the state and the city, the ruling was that transfer tax did not apply. So if you do have that situation, we, obviously would have to delve into that a little bit more, but something worth considering.
With that, we seem to have no more questions. We thank everyone for tuning in and spending time with us this afternoon. And if you have any further questions, please, you can contact either Alan or I, and we're happy to, at the email addresses that are in the presentation, and we're happy to address those privately with you.
Right. These slides also will be emailed around after the close of the presentation. Please feel free to use them as reference material, and they have our contact information on them as well.